Good afternoon. Thanks for joining us for today's webinar on the latest updates related to the Payroll Protection Program Loan Forgiveness. We appreciate you choosing to spend your time with us this afternoon. So as with all of our webinars, just a few quick housekeeping items. Today's webinar is being recorded and will be made available to all attendees. Attendees are encouraged to submit questions through the questions panel on the user interface. And questions submitted in advance of today's webinar will be answered towards the end of our discussion. So for those of you who have joined us for prior PPP or COVID-19 webinars, or have listened to our audio series, PROXUS Perspectives and Business Insights, some of our speakers today will be familiar. My name is Matt Rossler. I'm a Business Development Director here at PROXUS, and I'll be moderating today's webinar. With me today, I have Carol Kellogg, Implementation Navigator at PROXUS, and Steve Rossman, Shareholder at Drucker Scaccetti. New to today's team is Michael Weiner. Michael is a tax associate who has been with DNS for 2 years, and prior to DNS, he worked with Cohn Resnick in Bethesda, Maryland for 3 years. Mike graduated from Penn State University's 5-year Accelerated Masters of Accounting program and simultaneously earned his Bachelor of Science and Masters of Accounting. So during our time today, we're going to be covering a number of things. One is the PPP Loan Forgiveness Overview and Timeline. Then we're going to be going into Loan Forgiveness Application. We'll talk a little bit about the Paycheck Protection Program Flexibility Act, and then Carol's going to take us through the iSolved features before we wrap up with questions and answers. A short disclaimer, the information that's being presented today is purely for educational purposes and should not be considered legal or tax advice. So with that, I'll turn the mic over to Mike and Steve to talk us through the PPP loan forgiveness as we understand it today.
Matt, thank you very much. First off, I'd like to thank PROXUS for inviting me and Mike to talk to you today about the Paycheck Protection Program, specifically about forgiveness. We're sharing the information that we know currently, and guidance and additional information is sometimes released on a daily basis. So by the time we finish the presentation, some of the slides may be outdated, but hopefully not. Before we get into the details about forgiveness, we want a brief history of the PPP, otherwise known as the Paycheck Protection Program. The PPP program was part of the CARES Act, which was signed into law on March 27th. The intent of the program was to provide loans to small businesses to pay their employees during the pandemic. Companies applied for these potentially forgivable loans through their local SBA lender. During the loan application process, your two best friends were your lender and your payroll company, who help with reports and documentation needed for the original loan, and who will also help with documentation needed for the loan forgiveness application. Now let's talk about how the loans have been dispersed. Next slide, please. So there's been 2 rounds of funding. The first round started with applications on April 3rd and had been fully dispersed by April 16th. There was a total of 1.6 million loans, and the total amount of loans of money lent was $349 billion. When that first round ran out of money, there was a second round that was implemented, which is a total of $310 billion. That first opened on April 27th, and it's currently ongoing. So far, there's been 4.5 million loans written, and there's a little over $100 billion remaining as we speak. Next slide, please. So let's get into what we're all here to talk about today, which is the forgiveness application. The original application was released on May 15th. Mike, you want to talk about the different components of the application?
Yep. Thanks, Steve. Thanks. Hello, everyone. So yeah, I'm going to be going over the loan forgiveness application, the general questions and process of the actual loan forgiveness, and then we'll talk about the changes that actually occurred over the weekend. The original application was released on May 15th, and with the new changes that just happened on June 5th, this application is actually outdated right now, and we are likely expecting a new application. But for now, all of our information is based on the new law that has been passed and the application that that was released earlier in May. The application's made up of essentially 4 forms, which 2 are required. The Schedule A worksheet is technically not required. If you won't need it if you don't have employees, but it's pretty much required if you have to fill out Schedule A. You'll pretty much need the Schedule A worksheet, and there's an optional form to fill out borrower demographic information. The form also includes a bunch of certifications that need to be signed and initialed by the borrower, which pretty much are your standard certifications that the borrower needs to say that the funds were used properly and the calculations were made correctly. It also acknowledges that the federal government may pursue you for the loan amounts and additional penalties if you knowingly submit false information, and also lets you know that the SBA may request additional information after you apply for forgiveness.
So just to piggyback on what Mike said, the loan forgiveness application, you go through the same SBA lender that you went through for your original SBA PPP loan. So that same lender will be responsible for reviewing the information that you submitted. But as Mike mentioned, that you're self-certifying that all the information on the application is true and accurate to the best of your knowledge. Next slide, please.
So one of the certifications is the good faith certification. If you're a borrower that took a loan with a principal amount under $2 million, you're deemed to have made this certification automatically. If you took out a loan that was greater than $2 million, you actually have to check a box on the current form at least, and this kind of notifies the SBA that you are subject to an automatic review by the SBA where they'll go over your documentation that you submitted and your forgiveness. Now, that doesn't mean if you took out a loan under $2 million that you won't be reviewed by the SBA, but it's just to notify you that you are subject to an automatic review if you're greater than $2 million.
And again, just to complete that thought, the borrower, the company that got the loan, is actually certifying that all the information is accurate and complete. And again, as we mentioned on the previous slide, if there's fraud or not inaccurate information, but there's an intentional attempt to commit fraud, not only will you have to pay the loan back, but you'll also be subject to civil and criminal penalties. Next slide, please.
So the actual preparation, the form right now is called the Form 3508 PPP Loan Forgiveness Application. When you're actually preparing this form, you're actually going to prepare it in reverse. And you'll see when you actually take a look at the form that the front page for the loan forgiveness needs to be supplemented by Schedule A, and Schedule A needs to be supplemented by the worksheets to Schedule A. So you'll almost need to prepare it in reverse order. We discussed you'll file this with your lender, and they'll provide you with additional guidance. The documentation is also included on the instructions. And just briefly going over the documentation, you need to include your payroll taxes and proof of your payments used with the funds. So these are just receipts, canceled checks, etc. One thing to note that now you actually do not need to submit proof of your calculations. So we'll go over the calculations in a little bit, but you don't actually have to submit how you got these numbers, but just really just your payroll forms, which we'll also get into later. And this process could take up to over a year to a year and a half. A borrower actually has 10 months to apply for forgiveness after the cover period ends. the 10 months is actually taken from a wording in the new text that if you do not apply for forgiveness, your payment begins 10 months following the cover period. And once you apply, the lender has 60 days to respond to your application. And then the SBA actually has an additional 90 days to review the forgiveness after that. So it could be up to a year and a half, 2 years to actually be granted this forgiveness.
So just to piggyback on what Mike said, the current application is 11 pages, with the most important parts being the Schedule A, where you compute the amount of payroll that you're asking for forgiveness for, and then the Schedule A worksheet, which details each of the individual employees that you're requesting for forgiveness for the compensation paid to those employees. Like I said, the current application is 11 pages. Because of the new Paycheck Protection Flexibility Act, which expands the covered period from 8 weeks to 24 weeks, we imagine that there will be a new application or a modified application, because a lot of the forgiveness or the wording in the application applies to that 8-week period and the expenses during that 8-week period. So we're hoping that the new application, which is for the 24 weeks, is forthcoming very soon. Next slide, please.
So we're going to start to get into the actual forgiveness calculations. The first thing that we want to go over is the actual payroll cover period. So this is just the cover period when you're allowed to actually use the funds on certain expenses and potentially get forgiveness for them. Originally, the cover period was 8 weeks following the day that the loan was dispersed, or in other words, you received the loan. But the new law changed it to actually 24 weeks, but the borrower still can elect to choose the 8-week period. There's also an alternative payroll cover period, and this is really just to ease administrative functions. If you don't have a good payroll provider that can provide you payroll over the exact cover period, it allows you to elect a cover period that begins the first day following the first pay period of the PPP loan disbursement dates. And this actually, you can only apply for this election if you have a biweekly payroll or a weekly payroll period. And this only applies to payroll costs, so we'll get into what non-payroll costs are. But for non-payroll costs, you'll have to use the original covered period.
Yep, just to cover the salient points here. So there's the 8-week period, which came out with the original first set of laws, and then with the modified Flexibility Act, you can increase the covered period, which is the period that you have to spend the expenses in order for forgiveness, can be as much as 24 weeks. Next slide, please.
So a big debate when the expenses or the forgiveness guidance was first rolled out was paid or incurred. It used to be worded paid and incurred, which sparked all this debate, but they changed it to paid or incurred, which is pretty simple. For payroll, it's the day that the paychecks were physically distributed or the borrower originated the ACH credit transaction, and incurred, it's the date the employee's paid is earned. For non-payroll, it's the day the expense is paid and the day the expense is incurred. It's pretty simple, and the whole point is don't double count it. It's one or the other. A good example of this is your utility bill. Let's say the month of May falls within the cover period, and then certain June costs for utilities fall in, let's say, the 10 days of June, let's say your cover period ends today, you can still take the first 10 days of June, even though you likely don't pay your utility bill until July. And they put in this little caveat that the incurred expenses, they must be paid on the next regular payment date. So those 10 days of utility, you can prorate them for the 10 days for your June utility bill. And as long as you pay them by July, when the normal payment date is, you can include these expenses for forgiveness.
And the reason that the government gave you the option to use paid or incurred is because sometimes in order to pay, you might not know what your utility bill is until you receive it the following month. But the expenses that you incurred apply during the covered period. So even though you're paying it after the covered period, the expenses were incurred during the covered period. So the government wants to give you flexibility to include those costs as potentially forgivable costs. Next slide, please.
So the first kind of costs that we'll get into are the payroll costs. And these are your normal gross salary, wages, commissions, and this makes up your cash compensation. Also included in this is paid leave, vacation, parental, family, medical. It's important to note that there is a limitation to the amount you can pay as for cash compensation. And right now that limit is $15,385, which is calculated by taking your maximum limit of an $100,000 annual salary, dividing that by 52 weeks, and you'll multiply that by the 8-week cover period. Now, the reason there's a maybe there is this is kind of up for debate right now, and we're expecting guidance in the near future, but this was based off of an 8-week cover period, this 15,000 number, but since they extended the cover period to 24 weeks, there is a chance that you may be able to pay an employee up to 46,000. I don't forget the exact number, but it's going to be 3 times that amount. As for owners, they've come out and specifically said that owners are limited to this 15,000 numbers or 8 weeks of their total compensation. Now, there's a chance that they could extend this as well for the 24 weeks. We just don't know, but they specifically came out and mentioned this about owners, that they are limited. And that's cash compensation. Non-cash compensation didn't change as much with the new rules. This is actually in addition to compensation. So for employees, they are not limited to this 15,000 number. So these are employer paid health benefits, retirements, and unemployment for employees. And that's an important distinction because owners are not allowed to include their health, retirements, or unemployment compensation paid for themselves. An owner employee is a little bit different here. So C Corp owners, S Corp owners, the way they describe it, it doesn't matter if you're 2%, it doesn't matter if you're a 20% owner. As long as you're an owner employee, you are still limited to the 15,000 number. But if you make less than 100,000 annually, you can include your health and retirement benefits on top of, or at least to get to the limitation of the 15,000. And just some exclusions for these payroll costs. If your employee is a resident outside the U.S., they are not eligible for payroll costs. And the qualified sick leaves and the qualified family leave wages that were enacted with the Corona Response Act, if you claim the credit for these wages, you are not allowed to use the PPP funds for those wages.
So important points here are, again, we have to get some more guidance relative to if you use the 24-week period for the covered period, does the 15,385 cap apply, or is it 3 times that for the 24 weeks compared to the 8 weeks? In addition, the expansion to the 24 weeks gives a big benefit to companies because they have a longer time to pay the employer-paid health benefits and the retirement and unemployment in the second section there, which is the non-cash compensation. So that's unlimited. That's whatever the company pays during the 24-week period is includable as eligible for forgiveness. So while the cash compensation may be limited to $15,385 or 3 times that number, the non-cash compensation will be eligible for forgiveness for all amounts paid or incurred during that 24-week period if you choose the 24-week period for the covered period. Next slide, please.
So there are 3 other additional non-payroll costs that you can also spend your PPP funds on. We'll get into the nuances between the forgiveness calculations, and there's actually percentage thresholds on which you can spend these costs on. But 3 costs are your mortgage interest, as long as your mortgage was in place before February 15th, your rent payments, and then utility payments. Now, the definition of the utility payments are pretty straightforward, as you would expect: electricity, gas, water, telephone, internet. But they do mention this transportation there. And I've seen both ways. We need additional guidance on this. And by both ways, I mean, some people are saying these transportation utility payments are inclusive of auto payments and your gas or, personal vehicle expenses. But I've also heard an opposite thing where it actually may have to do with transportation utility, which isn't really common in the Philadelphia area. So I'm not too familiar with that, but I would be very cautious to include auto and gas in this utility payment category. And until we get more guidance, that's where our stance is with that. There's additional costs that are ineligible for forgiveness. There's costs. So the costs you pay for continuation of healthcare benefits for an employee that is on paid sick, medical, or family leave is not includable. And only mortgage interest is eligible for forgiveness. So not interest on any other debt obligations.
So just one point to bang home here is if you choose the 24 weeks of forgiveness, you would be able to take the mortgage payments that you make, the mortgage interest payments that you make during that 24 weeks, the rent payments that you make during the 24 weeks, as well as the utility payments that you make. So again, a lot more opportunity for eligible expenses that are eligible for forgiveness if you choose the 24-week period versus the 8-week period. Next slide, please.
So there's 3 general calculations that you have to make for the actual forgiveness calculations. And it is limited to the lesser of, number 1 here is the loan amount. You can't get forgiven more than you receive. And that's pretty obvious. Number 2 is your payroll costs divided by 60%. For the amount of the loan that you are requesting to be forgiven, 60% of that has to be used for payroll costs. If you don't meet that 60% threshold, or if you are slightly below, it doesn't mean you're not fully forgiven, but your is by that percentage. This 60% was actually decreased from 75 over the weekend with the new laws, and this should give borrowers some additional flexibility, no pun intended, for their loan forgiveness here. And then the third calculation is a little more complex, and we're going to go into it in the next coming slides. And this includes a wage reduction if you reduced any of your employees' salaries during the cover period, and full-time equivalent reduction, which is kind of if you reduce their hours or if you had to lay some of your employees off.
Yeah, the most important things to stress here are, again, you have to use at least 60% of your loan funds for payroll and payroll-related costs. Otherwise, you can't achieve maximum 100% forgiveness. And then again, if you change how much you pay your employees during the cover period compared to the base period, and also if you reduce your full-time equivalents during the covered period compared to the base period, then you will get less forgiveness than full forgiveness. Next slide, please.
Hey, Steve, are you there?
I am still here.
Okay, cool. I was making sure you can hear me. I had to switch off of my phone. My phone died on me.
Oh, no.
So I switched to the computer, but everything's good here?
You're good to go.
Perfect. Okay, so now we'll get into the third bullet point there, the calculation of the wage reduction. So it's important to note that it's performed on an employee by employee basis, and not all employees are included here. It only applies to employees with annualized salaries for 2019 for wages of an annualized salary less than $100,000. It also includes employees that weren't employed by the borrower at any time in 2019. So any new employees hired in 2020 would be included in this calculation. And with this calculation, you're basically just comparing their annualized wages for during the cover period, and you're determining whether they decreased since the first quarter of 2020. So you'd annualize your cover period wages. If your cover period wages were used during 8 weeks, you would divide by 8, find the weekly wages, and multiply that by 52 to get it annualized. The first quarter wages, for all intents and purposes, you just multiply by 4. And then you're seeing, did I reduce this specific employee's wages by more than 75%? The easiest way to explain how it would actually reduce your forgiveness would just be to compare this to a $100,000 annual salary employee. So if they make $100,000 and during the cover period, you reduce their wages to an annualized salary of $75,000, then you'd meet that 75% threshold. If there was below $75,000, let's say $70,000, that would be a $5,000 difference of their annual wages, but then you'd have to take the 8-week equivalent of that. And the 8-week equivalent of that would be a dollar for dollar reduction to your maximum possible forgiveness.
So the important point to stress here is, even if you've used 60% of your loan proceeds to pay for payroll and payroll-related costs, you have to do this additional calculation to make sure that you've maintained at least 75% of the salary costs on an employee-by-employee basis compared to pre-pandemic. So this calculation is layered on top of the original calculation, whether you've achieved the 60% threshold for payroll and payroll-related costs. So again, you could have a reduction of your forgiveness if you don't keep the salary level of individual employees at least 75% of what it was before the pandemic. Next slide, please.
Yep, and our next reduction calculation is the FTE reduction, which is full-time equivalents. This is also performed employee by employee. The first thing here that you need to ask yourself is, did I reduce any of my employees' hours because of the pandemic? Did I have to lay off any of my employees because of the pandemic? And if the answer to that is no, then you don't need to do this calculation at all. You need to just put a 1 on the form, it is not going to reduce any of your forgiveness. If you did end up reducing hours, the calculation is pretty simple here. You determine your average weekly hours for each employee on an employee by employee basis here. And you will take their average hours, divide that by 40 hours, and you'll get to some sort of decimal here rounded to the nearest tenth or limited to a 1.0. So for example, if they work 45 hours, that's just a 1.0. Anyone over 40 full-time is considered 1. If they work part-time, that's going to be a decimal. Now what you're doing is comparing, did this one employee work less hours during the cover period than they did to these choice of periods that are listed here. So February 15th, 2019 to 6/30/2019, or January to February in 2020. Now this is your choice of the period, whatever makes your reduction greater. So you're allowed to pick whatever is in your favor here. And you're just comparing, did I reduce any of their hours? If I did, it's going to be a reduction based on that percentage. And you'll average all your employees and get a percentage there. Also, to calculate the average weekly hour, especially if you have a ton of part-time employees that are working under one, they do provide a caveat here that you're allowed to elect this simplified method where a full-time employee is worth a 1 and everyone else working under 40 hours is worth 0.5. And this might make the calculation easier. It's hard to say if it will actually affect your forgiveness more or less.
So to recap, this test is really to see if you maintain your head count before the pandemic and also during the covered period. If it's the same, like Mike said, you're pretty much in the clear. You should have no reduction of your forgiveness. But if you reduced your head count, you have to go through this process to see how much of the forgiveness will be reduced because of the reduction in head count. Next slide, please.
Yep, and if you went through these calculations, the wage reduction and the FTE, and you found that, oh no, I did actually reduce hours, I did reduce some wages, there are safe harbors in place for you to recoup all of that forgiveness that you may have lost. And that safe harbor date was June 30th. So you can test on June 30th, hey, did I restore the wages, the headcount to what they were before the pandemic hit? And if the answer is yes, on June 30th, I'm back to normal, then you're good to go, no reduction applies. With the new law changes that came out on June 5th, they actually extended this safe harbor date to December 31st this year. So it's not clear right now if you choose the original 8-week period, if you're still allowed to choose the June 30th date, but my guess would be yes. And I think if you end up choosing the 24-week date, you still would have the new safe harbor period, which is on December 31st.
So this is really an out if you didn't achieve the head count based on the calculations that we went through on the previous slide. If you've restored your head count, at least for the 8-week period by June 30th, then you won't, both head count and salary level by June 30th, then you won't have any reduction because of this safe harbor. A couple of other points to note, which are in a subsequent slide. There's several exceptions to both the salary and wage deduction and the full-time equivalent reduction. These exceptions include if you attempt to rehire an employee and they say they're not coming back, you won't get penalized. The employer won't get penalized because the employer didn't come back, both on headcount and on salary rate. Additionally, if the employee is fired for cause, that's another reason that the employer won't be penalized for the forgiveness. In addition, if the employee voluntarily resigns or if the employee voluntarily requests a reduction in hours. Those are the four originally exempted reasons for not reducing your forgiveness reduction. And then there was two new exceptions that were added because of the Paycheck Protection Flexibility Act last Friday. If the borrower is unable to rehire the employees that were employed on February 15th, or similarly qualified, and they hire somebody else who's similarly qualified by December 31st, that won't be a reduction for forgiveness. And then additionally, the newest one is if a borrower is unable to return to the same level of business activity that they had before February 15, 2020 due to compliance with COVID-19 safety requirements, that won't have an impact on the forgiveness calculation. Next slide, please.
Yep. And so the next question is, what if some of these funds are not forgiven, or what if you have excess funds that you were not able to spend during the cover period? The unforgiven portion and your remaining funds remains a loan, and it must be continued to use for the qualified expenses that we previously discussed. The payments of the loan actually are deferred. Before the changes on June 5th, it was deferred 6 months, but they changed that to until the SBA remits payment to the lender for your forgiveness amount. So to apply for 10 months, the lender then has 60 days to review your forgiveness, and then the SBA has an additional 90 days to look into. Can you go back a slide, please? The SBA has an additional 90 days to look into, to review that forgiveness and pay them. So you may not have to start paying your unforgiven portion for an additional year and a half. Colton, can you go back a slide, please?
Let me pick it up right here. On the previous slide, the loan is due in 5 years, but it can be prepaid without penalty, and the interest rate for the loan is 1%. So all that said, the unforgiven portion, to the extent that you don't use all the funds for qualified expenses, that remaining portion, the unforgiven portion, becomes a loan, which can be paid over 5 years with an interest rate of 1%.
Yep, thanks. One more slide, Colton, please. The non-deductible expense.
We'll let him catch up, but we'll get started on when the loan is forgiven. The IRS has said that it's not income to the borrower, so basically it's tax-free income. The borrower receives the money and they don't have to pay tax as if it's income to them. On April 30th, the IRS issued notice 2020-32. Which basically says because the loan forgiveness is not income to you, the corresponding expenses are not deductible as well. So in the spirit of you don't have to pay tax on the income, you shouldn't necessarily be able to get the deductions that were used from that tax-free income to pay your employees. That's what the government's thought is, but it's still open for debate, and we're waiting to see if, even though the forgiveness is not considered income to the taxpayer, there may be a potential for the company to deduct the expenses that were paid under certain circumstances. That said, as Mike mentioned, the companies may not find out for a year and a half whether the loan is forgiven or not, and they'll have to file their 2020 tax return sometime before they know whether the loan has been forgiven. So I think it's up to the particular company to decide whether they'll deduct those expenses on the 2020 tax return or wait to see. Again, it's up for debate, and we need more guidance, but just wanted to put it out there to let everybody know what's going on. Next slide, please.
Yep, and I think we're running a little bit over time here. The last two slides are just kind of summarizing the changes, which we have gone over already in our slides for the most part. Just briefly going over the changes here. The cover period was extended from 8 to 24 weeks. With the election that you can still use the 8 weeks. The usage of funds for the payroll costs, they were reduced from 75 to now a 60% threshold. The safe harbor date extended from June 30th to now December 31st, which we discussed. Next slide, Colton. And the exceptions to the forgiveness calculations, as we went over the attempt to rehire and they declined your attempt, the employee was fired for cause or voluntarily resigned. They added 2 more, which we also discussed, whether you are limited due to COVID safety restrictions or you were just unable to hire the same employee or a similar qualified employee. And then there's the deferral of payments we discussed. Instead of 6 months, it's not until the SBA pays the lender. The loan maturity extended from 2 to 5 years. Now that 2 to 5 years, it's important to note that if you've already received the loan, you need to negotiate with your current lender to extend that 2 years to 5 years. You're not automatically extended. And there's a chance the lender could deny you. But right now it's so new, it's hard to see how the banks are responding currently. And then finally, the deferral for your payroll taxes. So this was another thing that came with the CARES Act, and you were able to defer your payroll taxes up until you receive forgiveness. That last part was distinguished. So now you're allowed to do both simultaneously. You can receive the PPP forgiveness and defer your payroll taxes for the next 2 years.
Great. Thanks for your help, Mike. I think at this point, we're going to turn the program over to Carol Kellogg.
Thanks, Steve and Michael. The report I'm about to cover is specific to iSalt, in that at this time it doesn't address the recent changes from the PPP Flexibility Act or Safe Harbor. But this will give you an idea of the mechanics and how the report will work. Next slide, please. To run the report, contact your assigned service representative by phone or email. You will need to provide the loan origination date. This is needed to determine the payrolls that will be used to include as part of the report calculation. To run the report, you'll want to navigate to Reporting, then to My Reports, enter the word Forgiveness in the search field, click Filter, enter the parameters on the right-hand side of the screen, click Generate Report, and then click click Go to My Report Queue to view the report. Next slide, please. So let's review the options. First, we have the weekly FTE hours threshold. This will default to 40 hours per week, unless another amount of FTE hours is entered. We recommend not to change this since 40 hours is the outline of the FTE calculation in the loan forgiveness application. We have the seasonal period begin date. For seasonal employers only, enter the season 12-week begin date between May 1st, 2019 through September 15th, 2019. The definition of these fields can also be found by clicking the eye icon next to the field. The weekly, biweekly coverage option, what we want to do is use the alternate payroll covered period for weekly and biweekly pay groups. This will use the first full pay period following a loan origination date and counting forward 56 days. This is used for weekly and biweekly frequencies only. The next one is use covered period for weekly and biweekly pay groups. This will calculate 56 days going forward from the loan origination date, prorating pay periods as necessary. Semi-monthly and monthly pay frequencies will automatically default using the covered period option. A new version of the report will be released this Friday and will include a new alternate coverage option that will start with the pay period beginning on or after the loan date. Also, a new option will be added for the loan duration of 8 weeks or 24 weeks to account for the new guidelines from the PPP Flexibility Act. The report will contain 8 tabs, 9 tabs if seasonal period was entered. The next set of slides will outline the information for each tab. Next slide, please. The next slide will emphasize the Employee Summary tab, which will display the loan origination date, as well as the date range for the loan period. You will notice that there's 2 columns for the average FTE. You as the borrower can elect the period of February 15th through June 30th, 2019, or January 1st to February 29th, 2020. The report will highlight the best options based on the results from the calculation. A third column for average FTE would display if a seasonal period begin date was entered. Next slide, please. The Schedule A tab will mirror the information needed directly for the application line by line. Next slide. The next slide addresses line 9 on the Schedule A. It addresses compensation to the owners. Owners are capped at the $15,385, which is the 8-week equivalent of $100,000 per year. In order for line 9 to calculate, the owner must be indicated in ISOL. To indicate an owner in ISOL, you'll want to navigate to Employee Management, Employee Maintenance, and then Employment. Select the employee, click Edit, enter the ownership percent, click Save. You'll want to repeat these steps for each owner. Next slide, please. Next, we have Worksheet Table 1, which displays the employees that had annualized rate of less than or equal to $100,000 for all pay periods in 2019, or were not employed by the borrower at any point in 2019. For salary, hourly wage reduction, it does a comparison by dividing the annualized wages for the covered period by the annualized wages for the first quarter of 2020. If less than the 75%, the reduction is applicable. The SBA has determined that there are exceptions for the FTE reduction, and they include, as Mike mentioned earlier, employees terminated for cause during the loan period, employees declined to be rehired during the loan period, employees requested reduced hours during the loan period. Now, these can be tracked in ISOL. You'll want to reach out to your service representative to add the miscellaneous fields for the purpose of tracking in this report. The totals from this page will be used to report lines 1 through 3 on Schedule A of the application. Next slide, please. Worksheet Table 2 displays the employees that had annualized rates greater than $100,000 for all pay periods in 2019. The amount is capped at $15,385 for each individual. The totals from this page will be used to report lines 4 and 5 on Schedule A of the application. Next slide, please. The Employee Wage Detail tab contains the comparison of Q1 2020 wages versus the loan period wages based on 75% of Q1 2020 applicable wages. The formulas for this calculation is displayed on the tab. This calculation will be adjusted based on the recent updates from the PPP Flexibility Act. We will keep you posted once the updates have been completed. The report will also show who has been excluded from the wage reductions along with the reason. Next slide, please. The next two tabs, 2019 hours and 2020 hours, are providing the hours and FTE count by month to support the information for line 11 on Schedule A of the application. Next slide. The final tab of the report is the Employee Loan Period Details tab. It includes payrolls during the loan period, including paid hours and paid wages. The employer share of health costs, as well as the employer deferred comp match, will display if calculated with payroll. State local employer tax will consist of the calculation for the employer's state unemployment tax and any other state and local employer taxes paid. This completes the PPP Loan Forgiveness Report information. So at this point, I'm going to turn it back to Matt for questions and answers.
Perfect. Thanks, Carol. Thanks, Mike. Thanks, Steve. So we'll spend the remainder of our time today together addressing the questions that have been submitted to us by our participants. Just a quick reminder, as we said a little while ago, the following are pre-submitted questions that were sent in prior to today's webinar. The information that Mike and Steve are going to go through is the information as we know it today. And if you have submitted any questions during today's webinar, we'll be answering those after the webinar is concluded when we send out the recording of today's conversation. We're having a little bit of a lag in the slide transition here. Do apologize for that. It's internet connectivity when you work from home, so it's a little bit of a struggle, but we'll get to the first question here in just a second. All right, very good. So Mike and Steve, I'm going to read off the questions here, and then feel free to jump in and take it whoever has the answer. So the question that was presented to us is, not all of our employees regularly work 40 hours. So how do we handle determining FTE hours when FTE is defined more restrictively now than when we applied for the loan? Second question there is, are owners disqualified from the 75% threshold for forgiveness?
I'll take that one, Matt. Basically, what you have to do is you have to compare the FTEs before the pandemic to the FTEs during the covered period. If you have all part-time employees, the average amount of weekly hours per employee should not be impacted if they don't regularly work 40 hours. But only if the hours they regularly work have been decreased during the covered period, that's where you might have some reduction in your forgiveness. As we mentioned in the presentation, owners are not included before or after as part of the FTE calculation, so this will not reduce your forgiveness.
All right, very good. Thanks for that, Steve. The next question we got in is, if we're not able to use all of the funds within the 8-week period, do we only have to pay back the amount that was used?
So in order to receive forgiveness, qualifying expenses must be paid during the 8 or now expanded 24-week period. Any expenses that are not forgiven can be paid back immediately or used as a 1% or is used as a loan at 1% interest, and the repayment period can be up to 5 years.
Other than the $100,000 salary, are there any limits, Mike or Steve, to how much compensation you can pay? So in order to compete with unemployment comp, we paid our employees what they made on their busiest 2-week period, for example.
So all cash compensation paid to employees, including bonuses during the covered period, either 8 weeks or 24 weeks, is subject to the $100,000 annualized cap. All of those cash compensation are eligible for forgiveness. In addition, on top of that, employer-paid health insurance and retirement contributions are eligible for forgiveness, like I said, in addition to the cash compensation paid to employees. So you compute based on your payroll records for the covered period, the capped amount, whatever that is, either the $15,385 or potentially 3 times that. But in addition to that, you get to deduct all of the health insurance paid by the employer as well as retirement contributions paid by the employer during either the 8-week or the expanded 24-week period.
Yeah, and I think it's worth noting that the emphasis on the busiest 2-week period, that's fine. You can pay them more than they would normally make on average, and bonuses are acceptable too.
Perfect. Thank you both for that clarification. Not sure if we're going to be able to jump to the next question here or not.
Hey, Matt, I have it up here if you'd like me to read it.
Yeah, Steve, if you have it there on your end, that'd be great if you don't mind. Thank you.
Sure. We're a school with substitutes and people that don't work in the summer. Will they count against us when counting if we rehire or gave employees their full amount of back hours when we wouldn't normally pay them for the extra time? Mike, do you want to take that?
Sure. So the calculation for forgiveness compares FTEs during the covered period to the FTEs during one of the 2 options that you choose. So the 2/15/2019 to 6/30, or January 1/1/2020 to February 29th, 2020. In addition, there are several safe harbors for the FTEs. Also, if you choose a 24-week period, many of the part-time employees may be paid during that time period. You can choose the period or the safe harbor that will maximize your forgiveness.
Next question. What documents will be required to prove FTEs?
Yeah, so we briefly mentioned this during our presentation here, and with the application likely changing, this may change, but for now we're kind of basing this on the original application, and that includes federal payroll filings as well as state and unemployment filings that include the cover period, but likely extend beyond the cover period. In addition to that, on Schedule A worksheet for the loan forgiveness application, the borrower is required to list applicable employees and their respective FTE amounts. Actual calculations are not required to be submitted, but must be retained by the borrower for 6 years after the loan is forgiven. And I think that's the most important thing, especially for small businesses like we have here today. Keeping your information for 6 years is pretty important here.
Perfect. And Steve, looks like I was able to pull up the questions here on my end, so I'll pick it back up for the last few that we have. The next question we had was, when are we supposed to submit receipts for rent, healthcare, utilities, and payroll stubs, and to who do they get sent?
I'll grab that one, Matt. Proof of payment for the qualifying expenses are submitted along with your loan forgiveness application to your SBA lender when you apply for the forgiveness. Obviously, you want to start to compile all that stuff as you're going along during the covered period, but all of the documentation it's submitted along with the loan forgiveness application when you apply for forgiveness.
All right, very good. So just two last questions here before we wrap up. When can we start applying for loan forgiveness?
So I can take that. You can apply for forgiveness immediately following your cover period. And like we just discussed, you should begin to start gathering your supporting documentation as soon as possible during the cover period. With the extension from the 8 weeks to the 24-week period, it's actually unclear when the borrowers can apply for the forgiveness, because a lot of people are asking, hey, maybe it's not taking me 24 weeks to spend my entire loan. What happens if I complete all the forgiveness requirements within, let's say, 14 weeks? Can I apply after 14 weeks? That's kind of up in the air right now, and we're waiting for additional guidance.
All right, very good. Thanks, Mike. And then the last question we had is related to union contributions. So is the employer portion of union contributions eligible to be used with payroll for loan forgiveness?
At this point, we don't have clear guidance on this particular question, but based on what we do know, it would be logical to expect that components of the union contributions would be deductible, especially where they mirror the deductible expenses for, or eligible expenses for, forgiveness, including healthcare benefits and retirement benefits that are for the employees. So we don't know for sure, but I would just imagine, because those are allowable costs for forgiveness or eligible costs for forgiveness, healthcare benefits and retirement benefits paid by the employer for the employees would also be similarly situated for forgiveness as well.
All right. So that's going to wrap it up for the question portion of today's conversation. The last slide that we have here is a helpful resources slide, just like we've put out in our previous webinars. So a couple links here to helpful areas related to COVID-19, FFCRA, and the CARES Act. Aside from that, thank you all for joining us today. Please don't hesitate to reach out to either PROXUS or the team at DNS with any additional questions that you may have now or in the future. Thanks again, and everyone stay well.